All right, Applied Math. Today we are actually looking at the last section of this unit on taxes. We've looked at how to report our income. We've looked at how to pay our taxes, how to look up how much we owe. And this last section is all about reducing your tax liability. So a couple terms that we want to look at are tax avoidance and tax evasion. So the IRS every single year publishes thousands of pages of tax laws that you have to go through if you want to do your taxes. Now we've looked at Form 1040 mainly and the instruction manual that comes with that, which is 122 pages on its own, but there are so many other ones that go with businesses, self-employment, and a lot of those forms have instruction manuals of their own. Most of them you will never use, but they are there if you need to. So a lot of these laws are beneficial to you because they allow you to pay less in federal taxes. Now you may be asking yourself, well, why are they passing laws? Why is the government passing laws to make me pay less in taxes? And a lot of times it's because they want to encourage certain behavior. So when Congress comes in and makes something like a tax credit for buying an electric vehicle, that is because they want to encourage more people to buy electric vehicles to get gas guzzlers off the road. Or if Congress does something like increase the amount that you can make a deduction on say, mortgage interest. They are trying to encourage people to buy houses instead of renting. So they create these laws to try to adjust people's behavior with what's essentially a little bit of a bribe, but it does help you out. Okay, so paying less in taxes, looking for these deductions and credits, is called tax avoidance, and it's completely legal. In fact, it's something that you should be doing. You don't want to have to pay the government more than you have to. So anytime you use a deduction or a credit, you put that on Form 1040 or one of the attached schedules, you are practicing tax avoidance. And again, totally okay. In fact, it's encouraged. The other flip side to this is called tax evasion, and that's when you lie on your tax forms. So this is not legal. You can't lie to the IRS. They will find you eventually, and you're probably going to get a pretty hefty fine. And if you lie enough and you don't have good enough lawyers, you might see some jail time on that. So do not lie to the IRS. Every time you get a W-2 from your employer, the IRS also gets that W-2. So when you fill in that information, if you fill it in wrong, they are going to find out. It's not going to be immediately, but they will eventually find out and they will hit you for it. So let's look at some of those tax avoidance options as we look at deductions and credits. So the first thing, deductions are expenses that lower your taxable income. This means that because you have a lower taxable income, you pay a lower amount in taxes, which is a good thing. So you could use deductions to lower your income all the way to zero, but you can't lower it below zero. I mean, if you get your deductions to get your income down to zero, you owe nothing in taxes, but you don't get anything extra past that. The difference between that and credits are that credits are amounts that you subtract from your taxes after you look up the amount on the tax table. So you've already figured out your income, you've already figured out how much you owe or how much of a refund you get, then you apply the credit. So credits can actually help you after your income goes all the way to zero. So credits are applied 100% in your favor. Deductions kind of max out. Credits do not. Some common credits are the child tax credit, which is, I forget, I would have to look it up, somewhere around $2,000 a kid that you get $2,000 for having a kid that's your dependent. And the earned income tax credit, which is kind of an alternate way for lower income people to pay their taxes that does get them a credit in return. So again, the difference between deductions and credits: deductions lower your taxable income. There is a maximum to them because you can't go below zero. Credits, as long as you can apply them, they go completely to you. And the amounts of these deductions and credits change from year to year. Okay, let's look real quickly at a couple forms to finish this video out. So the first one is Schedule 1, which is titled Additional Income and Adjustments to Income. We saw this in the last section because we looked at part 1 of it, where we put additional reported income in, such as like game show winnings or alimony. Additional credits and deductions, however, go in part 2. Okay, so here is Schedule 1. Right here we did part 1. We looked at some of the money that we report to the IRS so they can charge us more taxes up here in part 1. Part 2 is money that we deduct. So these are things such as educator expenses. If I spend a lot of money in my classroom and I'm itemizing my deductions, I can write that off. Business expenses, even though you have to attach another form here. Health savings account. So sometimes you can get money taken out pre-tax from your employer to go towards health care, and that's called a health savings account, and that does not count towards your income. Moving expenses for armed forces members. Some of you will go into the armed forces. Sometimes they move you around to different bases, and you can get the expenses for the moving written off. Other things such as self-employment taxes, penalties on early withdrawals of savings, alimony if you're the one paying instead of receiving. This can all be adjusted on your income, and that way you don't have to pay quite as much. But most of these are deductions. They are not credits. So the best that they can do is reduce your income down to zero. The other important schedule that we're going to look at here is Schedule A, which is itemized deductions. So you use Schedule A if you are not taking the standard deduction. So everyone on Form 1040 has the option to take a standard deduction, which I believe is $12,400 this year. That is money that is just taken off of your income and you don't have to pay taxes for it. If you think that your deductions should be more than that $12,400, then you can fill out Schedule A and itemize those deductions. So deductions that you can itemize are include but are not limited to things like medical and dental expenses. So say you've got to get some crowns and they're going to cost you a lot. Maybe you don't have dental insurance. You can write that off as an itemized deduction. Taxes paid in various jurisdictions. If you end up having to double pay taxes for whatever reason, you can write off what you paid, and that doesn't get counted towards your income. Mortgage or other loan interest paid. If you have a house and you're itemizing your deductions, you can write off the mortgage interest that you paid. You can't write off the amount that's actually going towards the house, but you can count the amount that you're paying to the bank as interest against your income. So that reduces your income, meaning that reduces your tax. Charitable donations. So if you, for example, send a couple $1,000s to your church or to Goodwill or the Salvation Army or anything like that, or give your car to the blind or the vets or Cars for Kids. Those are all charitable donations and they reduce your tax liability. And another one is loss from theft. So if your house gets broken into or your apartment gets broken into and you lose a lot of stuff, like they steal some jewelry, they steal your TVs, they steal your PS5, whatever you got, if you can get the insurance company essentially to agree that you've had that or get the police to agree that you had that, you can write off those losses as a loss to income because in theory you have to spend money to replace the stuff that got stolen. So let's take a look at Schedule A real quick. Okay, so here it is. We've got medical and dental expenses, and again, you cannot include expenses reimbursed or paid by others, so essentially that means insurance companies. Like if the insurance company pays your $50,000 hospital bill, you don't also get to write that off. You only get to write off what you paid. Taxes from state, local taxes, general sales taxes. You can write those off. Interest you paid, such as home mortgage interest, gifts to charity, casualty and theft losses, and then other itemized deductions, which there is a instruction for Schedule A which has those. And then you can add these up in line 17 here, and then you can write that off your taxes. And it's generally only good to do this if the amount that's going to go in box 17 is more than the standard deduction. Otherwise, you're losing money on it. Okay, that's all I've got for this lesson. Like I said, this is the last one in Unit 6 here, talking about taxes. We are going to continue playing around with some 1040s, filling out some forms ourselves, crunching some numbers. But as far as videos go, this is it, and I'll see you in class.